Alright, let's start with the basics. Financial institutions employ the strategic approach to sustain the facade of a performing loan artificially. It involves the extension of additional credit to borrowers facing challenges in meeting existing repayment obligations. By facilitating new credit, the borrower can ostensibly service the outstanding debt, creating the illusion of financial health. For instance, consider Bank X extending a substantial loan to individual person Y for a real estate development venture. As unforeseen circumstances impede Y's ability to meet repayment obligations, signs of distress emerge, elevating the risk of classification as a non-performing asset or NPA. In an effort to avert the adverse repercussions associated with NPAs, Bank X extends another loan to Y, affording them the means to settle the preceding debt. This is commonly referred to as evergreening. Primarily, the objective of evergreening is to circumvent the classification of loans as non-performing assets on their financial records. Such classification can have deleterious effects on a financial institution's fiscal health and subject it to heightened regulatory scrutiny. By perpetuating the semblance of a robust loan portfolio, these institutions seek to uphold investor and depositor confidence. Now, before we get deeper into the RBI's move, let's talk about AIFs. That's short for Alternative Investment Funds. Think of them as the cool kids on the financial block. They pool money from different investors and play the market with strategies that are a bit off the beaten path. Venture capital funds, private equity funds, real estate funds, you name it, they are in the club. In a recent circular, the Reserve Bank of India has explicitly stipulated that regulated entities encompassing banks and non-banking financial companies are precluded from making any investment in schemes offered by alternative investment funds or AIFs that possess directly or indirectly investments in the borrower company. Imagine this. Bank A extends a loan of Rs 100 crore to Company X while concurrently investing in an AIF named Y. Subsequently, Y channels its investment, whether through debt or equity, into X. The crux of the concern lies in the potential utilization of funds acquired from Y by X to mitigate its exposure to Bank A. As a consequence, Bank A, instead of maintaining a direct loan connection with X, acquires an indirect exposure through its investment in L. So now, no such investments are allowed for banks and NBFCs. Now, what if Bank A has already executed its investment before the issuance of the RBI directive? In such a scenario, the RBI mandates regulated entities to divest their stake in such AIFs within a stipulated period of 30 days. Failing this, 100% provision is necessitated for such investments. Moreover, it has been observed that non-banking financial companies and banks held junior or subordinated units issued by AIFs, while superior units were allocated to overseas private equities or venture capital partners. In response, the RBI has expressly prohibited regulated entities from holding junior or subordinated units.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.